Hello and welcome to this special SharePad webinar. I'm Maynard Paton, and for the next hour or so I'll be hosting this live version of my screening for my next long-term winner article. So this webinar will be in two parts. So for the first 45 minutes I'll show you how I use SharePad, demonstrate some filters I've used in my articles, and look at 3 different companies using various SharePad features. And straight after that there'll be 15 minutes of Q&A. So if you're watching this live on YouTube, please use the chat facility to pop in your question during the webinar, and feel free to ask me anything about this webinar, SharePad, or investing in general. So let's get started. And I'm going to use for this webinar 3 filters that I've used in my articles. So I'm going to look at the filter I used to pinpoint Runnyshaw earlier on in the year, and also Rightmove and Medica. So let's click down on Runnyshaw here. We can scroll down here. So I'm going to apply this filter now in SharePad. So we're going to click onto SharePad. I'm going to apply filter. So if you've not got this filter installed in your SharePad setup already, you can click Library and scroll down and find Maynard Paton Runnyshaw here. You can then click Install and install it into your own SharePad setup. But I've already done that. That's here. So just press OK. And here we go. So this filter was looking for shareholder orientated companies, shareholder friendly companies. So the criteria here at the bottom, I was looking for directors with a minimum of 5% of the company, so they had a fair amount of interest in the company, so their interest should be aligned with us ordinary shareholders. Also looking for companies that had increased the dividend over the last 10 years. So not only the directors hold a lot of stock, they've rewarded investors with a rising dividend. So a minimum of 7% I've looked for here. And also companies where the share count hasn't increased over the last 10 years. So the directors haven't diluted shareholders by issuing options willy-nilly or issuing shares through acquisitions. So I've got 17 companies. It's SharePad's returned 17 companies. That was Runnyshaw earlier on in the year. I'm going to look at XP Power Limited. So Limited, it's got Limited after the end of the name. This is interesting because companies which are domiciled outside of the UK, so maybe on the Channel Islands, Isle of Man, or anywhere outside the UK, they have different disclosure rules. And so the reporting may be slightly different from standard UK companies. That's something to bear in mind. So XP Power, we're going to move over here to the company tab, and if we scroll down, here we go. We can see here the company is actually domiciled or based in Singapore, and the AGM here is, if you want to attend the AGM, it's in Singapore, so bear that in mind. What does this company do? It's a manufacturer of critical power control components. So the word critical is interesting here because that sounds like it makes important products that must work. So I wonder if this company has a competitive advantage here, or the customers are willing to pay a premium price here for the products. So that's interesting. Looking down at the directors, I see the Chief Executive Officer. He's been here, or at least served on the board, since 2003. So we've got a long-standing management here, and we can look on the original filter side here. The directors own 9%, and if we can click on DD, we can, let's get rid of that. We click on, here we go. We can find the directors up here, and James Edward Peters, who's the chairman, so he owns 8% of the company, and the company's worth 562 million. So he has about 40 million pounds riding on the share price. So that's good. So hopefully he's going to look after all shareholder interests here. So that's good. Let's look at the summary now. Financials and summary. So the growth forecasts there, they look mixed. So EPS down 12%, that doesn't look good for the current year. Debt has grown, that's doubled, more than doubled in the last year to £64 million. Cash conversion, that looks poor. So earnings haven't converted well last year into free cash. It's paid a dividend for the last 12 years. That's good. The margin at 20%, that looks good as well. So maybe the customers do pay premium prices for these products here. So the margin's good, and the ROE at 27%, that looks healthy as well. So let's look at some charts now. So I'm going to show you find out how this company has done over time. So I'm going to look for revenue. If you read my articles, you may be familiar with these charts. So this is XP's revenue history. We can see revenue sales going up nicely, so that looks good. Let's look at profit. Let's extend this out. And profit's been rising nicely as well. Pretty good. The margin. Here we go. So it had a margin of 20% the last year, and we can see here 1, 2, 3, 4, 5, 6, 7 years of plus 20% margin. So it's a profitable business. That's good as well. And the ROE, return on equity, let's extend this out. So it's above 25% the last year, and it's generally been above 25%. So this is a good looking business, I think. And the dividend, and that's been rising nicely as well in a nice smooth manner, so that looks good. So let's have a look at the debt, because that had increased on the summary. We saw the debt increase, so we can look here. So this shows, so green is cash on the balance sheet, red is debt, and we can see the company has operated with net debt generally, and all of a sudden last year debt has surged. So why has debt surged? We need to find that out. So we're going to look at the financials, look at the cash flow, and we can go down here, new borrowing, and we can see here last year 2018 took on 39 of new debt, but took on 25 of new debt as well, 25 million. So where's that debt been, why has that debt been taken on? So we can look at further up, and we can see acquisitions, and it's here. So last year the company spent 35 million on acquisitions, 19 million. These are large sums. If we look up here, net profit earnings last year was 30, and it spent everything, all its earnings, on acquisitions. And the year before, so the last 2 years, this company has spent just pretty much all of its earnings on buying other companies. So that's something to bear in mind. So with acquisitions, there's always a risk that maybe the core business is running out of steam, and the directors have decided to buy in growth by buying other companies, or there's also an integration risk as well with acquisitions, or maybe they've just paid too much. I mean, it's difficult, but it just increases the risk of trouble ahead with acquisition. So let's look at the balance sheet and just see how much debt there is. Has the company borrowed too much debt? And XP issued half-year results not so long ago, and we can look down the screen and find 56 here, 56 million of debt, and we can compare that to income. And so we have profit in the first half of 14, which is down on last year. And so profit is running at about 35 million a year versus debt of 56, which not truly excesses, but there's debt. There's not insignificant amounts of debt there. So that's something to consider. Let's look at interest cover as well. So the first half was 1.6. We double that to 3.2. Profit of about 35 now. So interest cover is 11. So again, debt's not excessive, but looks manageable. But it's again something to monitor. So we can use this chart. I'm going to show you this one as well. This puts the acquisitions into perspective. So the green bars are free cash flow, and the pink bars are dividends, and these red bars is the amount spent on acquisitions. So you can see large amounts spent on acquisitions compared to free cash flow. So the other issue from the summary was this free cash flow conversion. So let's go and look at this chart. And here we go. And let's extend it out. So green is earnings and red is free cash flow. And the black line is the ratio between the two. So what has happened here? So earnings are here, and then where has all the cash gone to end up with free cash flow? Your acquisitions are actually spent from this amount here. So where has the cash gone? And we can look at this chart, which is this one. And this is earnings in green, and the red bar is the cash working capital. So we can hone in on the cash working capital movements, and we can look at financials, cash flow, go back to the yearly, and changes in working capital here, this line. And so in 2014 it was -4, -4, -6, 0, and then all of a sudden it's jumped up to £22 million, which is a huge amount compared to the earnings the company made. So it made 30 million of earnings, but 22 million went into working capital. So what happened here? I mean, these movements are significant, and you need to understand what is going on. So no wonder the debt shot up, because the 30 million of earnings, 22 was invested in working capital, and then 35 spent on acquisitions as well. So there's lots going on here. We need to look at the news now to find out about these working capital movements. So news, and the 5th of March was the results. And we can scroll down and find out what's going on. Here we go. Found it. Supply chain. So the company talks about a significant tightening of the supply chain for certain electronic components, which resulted in increased lead times and component cost inflation. In response, we went into the market to secure supplies of critical components at prices beyond our standard costs. So what's happened here is the price of their supplies have gone up, and they've just had to pay up. So they've all the money spent into their working capital is essentially the price of their components has just risen significantly. So this is interesting, because I wonder who has the power here. Whether do the suppliers have much power over this business, because they're supplying critical components. So maybe XP just has to pay up. I don't know. So what I do think will happen is that margins will come under pressure now, as the higher cost of stock will filter through into the forthcoming results, and maybe put pressure on the margins, or certainly will put pressure on margins. We can check what's happened with go back to the headlines, and let's look at these half-year results. What's happened here, and we can see that revenue was up 6% in the first half, but the profits down 18, down 17, and that looks to be because of gross margin. Here we go. So gross margin of 44. Margins have fallen 2%, and that's down to the increase in stock. So that's not great. So let's go back to the financials. Let's look at the forecasts. So we've got the half year, and we can see earnings down 12%. I think, and you've got pre-tax down 4%. I think earnings, that may be different. That 12% may be due to SharePad and the brokers and the company itself having different ways of compiling earnings. I wouldn't be too worried about that. I would look at the 2021 figures here. Just show modest growth, and I think 2020 figures balance out the 2019. So a general picture is a company of modest growth here, with 4, 5, 6% sort of growth. So modest growth. Let's look at the summary. So you've got 19 times earnings for, let's say, modest growth. You've got a lot more debt, poor cash conversion, problems with the suppliers. So lots of things are going on here, and I think this margin figure will come down in the next well, certainly this year, maybe next year as well. So I think the track record of this company is good, but there's lots going on with acquisitions, debt, poor cash conversion. The supply is also causing a bit of trouble as well. So this could be what a share to revisit maybe in a year or two's time when some of these issues have resolved themselves, hopefully. So let's skip out of that one. Let's look at a second one now. And we're going to look for this one, so Rightmove. So the filter I use for Rightmove, and here we go, this was it. And I'm going to filter, apply, scroll down. Again, you can use the library to install this, and I'm going to click on Rightmove, and OK. So this filter, this screen was looking for super cash generators, companies that can convert all their earnings into cash. So 100% of earnings in the last year into cash, and over the last 5 years the average of 100% as well. So it's also looking for companies that did something useful with their cash, so pay off the dividend, so a net cash position here, and pay a rising dividend. So I've looked for at least 5 years of a rising dividend here, and I've got 9 matches, and I'm going to look at this one. So Headland Group. So what does this company do? Scroll down. Here we go. It talks about floor covering products, which I take to mean carpet and such like. So this business doesn't actually manufacture carpet. It's a middleman, so it buys carpet from smaller manufacturers and then distributes it to trade buyers. So it doesn't actually make the carpet, it just distributes it. So it sounds dull, but reassuringly dull, I would say, because a lot of dull companies can do well in the stock market. The directors, let's have a look at the chief executive. He's been here, or at least on the board, since 1991. So again, a lot of experience there. He's 65, so he could be close to retirement. That's something to bear in mind. Summary. So the rating here is only 12 times, so that's a modest rating. The yield is 5.5%, so that's attractive as well on the face of it. Look at the forecast. The forecasts aren't great, with EPS down 10% forecast in the current year. Debt is up a little bit, but 7.3 million, so that looks small compared to the market cap of 380. There's a pension deficit as well, which looks small too. Cash conversion, as we know, is over 100%, so that's good. It's paid a dividend for a long time, 27 years. So the margin though, 6% margin, that's low, which is probably what you would expect as a middleman, as a distributor. Does it have a moat, this business? I don't know. The ROE, return on equity, looks, it's not spectacular but not awful either, so that looks okay. So we can check the history. Let's do financial charts. We look at revenue. How has this business done over the years? So revenue next to nothing and up to 700 million, so that's impressive. Profit. So this is interesting. So the latest profit is not as high as the profits pre-banking crash. So during the credit boom, profits went higher and then fell and not really recovered. So let's check the margin. So the margin was 6%. Oop. There we go. So the margins come down as well. So that used to be 9 and now it's 6. So something's happened in 2008, 2009 where the margin has come down and not recovered. ROE. So this is, again, so we're getting a story here of the ROE's come down as well. So it used to be above 20%, 2003, 4, 5, and then came down, and then it's not really recovered. So there's a picture developing here of this. I wonder if this business is sensitive to the economy. It had a setback in the banking crash, and is not, some of the measures haven't really recovered. Let's look at the dividend. So you can see the dividend was chopped in 2009, and that has recovered. So something's happened here for this business during the banking crash, I think, the setback. So I wonder if it was sensitive to the economy. I don't know, but let's have a look at the cash flow conversion. So we can see here. Right, there we go. So green's the earnings, red is free cash flow. You can see the red bars above the green. That's what you want. The free cash flow here, that's good. So let's look at cash and debt. So cash is green, borrowings are in red, debt's red, so the debt's being paid off, that's good. And we look at that pension deficit. This business did have a pension deficit, so we can see the pension deficit in red. So earnings are in green, and the pension deficit has come down. That's looking pretty good. Pension deficits, in my experience, don't seem to disappear. So even though it's come down, I wouldn't expect that to disappear anytime soon. Always worth checking pension deficits. This scheme has got assets of 120 million, pays out benefits of 6, and company contributions and interest on those assets come to about 4. So it's a manageable scheme, but it's worth double checking the movements on the deficit and the pension scheme itself. So this is an interesting chart. This is perhaps the most important one for Headlam. So this is green. Green is earnings, and the blue bars are the interesting ones. This is the difference between cash spent on capital expenditure and the depreciation, the associated depreciation charged against the income. So usually companies spend more cash on capex than they charge against earnings as depreciation, but in this case it's the other way around. It's probably better if I look at, so here's a depreciation of 7, but against earnings, that's the charge against earnings, but capital expenditure last year was 4.4, so it's the same again here, 5.8, but capex was 3. So let's go back to the chart. So there could be 2 reasons for this. Maybe there's conservative accounting where the company is purposely generated a large depreciation charge and not spending as much cash, maybe, or maybe there's something sinister going on where the company's underinvesting in its assets, so it's not spending anything on its assets, and the trouble with that is that maybe in a few years' time the assets will wear out, they'll need replacing, and a huge amount of cash will have to be spent on new assets. So we need to find out what's going on here with capex and depreciation, because that's important, because that's why Headlam cropped up in our filter over here, because of the large depreciation charge and the company not spending as much on cash. That's why it looks like a cash generative business. So we need to look at the balance sheet. So financials, balance sheet, and find out what the assets are. And we've got tangibles here of 102. So this is a big number. We need to look at exactly what that 102 is. So we can go to the news, and we can go to the 6th of March, which is here. And we can scroll down. Here we go, capital expenditure. So there's a line here. It says, in addition to ongoing maintenance capital expenditure of typically £3 to £4 million per annum in connection with running a largely freehold property portfolio. So this is interesting. Those assets, those 102 we saw on the balance sheet, it's a largely freehold property portfolio, and they just spend 3 to 4 million every year keeping that portfolio in good shape. So of the 2 options, I think this is conservative accounting, because what I suspect is going on is they're depreciating this this freehold property portfolio. But if you think about it, freehold property really should maintain its value. So I think that's what's going on here. They're depreciating this portfolio and spending 3 to 4. So I've checked the annual report and the freehold is worth, they say, £85 million, which is not insignificant when you compare it to the 380 market cap here. And when you think about the summary, remember this ROE of 15%, so freehold property generates a lowish return, maybe a rental yield of 5-6%, and the company did have cash of 44 as well. So 44, 85 of this 102 is low return assets. So this number here, this is better than I thought originally. This 16% is now, I think, pretty good considering all the cash and freehold on the balance sheet. So that's impressive, I think. Something else I'm going to show you is this financial chart here, and this one. This is impressive as well. This chart compares stock to turnover as a percentage, which is in red. The blue line is trade debtors here, and the pink line is trade creditors. So these are all working capital entries, and apart from this blip in 2014, the lines are all straight. So consistent working capital management here, which is very encouraging, I think. So it gives a good feeling about this business and the cash generative impression of this business, where it's got conservative accounting, I think, and the cash management. Even though profits have been up and down during this period, cash management with working capital is being pretty good. So that's impressive as well. Let's have a look at financials. This is good. These blue bars represent special dividends. So the company's paid out 2 special dividends recently. Always good sign to see management handing back surplus cash to shareholders. Let's have a look at the forecasts, which is here. So we can see sales flat, profits down a bit, 5%, earnings down. Again, I think that's the distortions between SharePad and the company and the brokers. I would look at these figures, I think, as a general, because we have a rebound here to 2020. So again, modest growth is 4%, 5%. So the general picture is modest growth, I think. We're going to check the news. We're going to go to the 28th of August, which was their half-year results, and we can see modest growth here, modest growth here. Something I like about these results is this table here, where the company discloses extra information about how profit has changed. So volume benefit, pricing benefit here as well. So I think they've had to cut their prices, which caused profit to decline a little bit here. But the extra disclosure is useful. Companies that disclose more information tend to be the better companies, or better companies tend to disclose more information. So this is all very helpful and gives me a good feeling about this business. So let's go back to the summary here. So it's a modest PE, modest growth, but I think these earnings could be understated. You've got the freeholds in this business as well. The liabilities don't look too worrying at all. There's a nice yield. The issue is, does this business have a moat? I don't know. But I would look at this business, and is it sensitive to the economy? If there's a recession, would it be impacted? I don't know, but I would look at this business certainly ahead of XP. I think of the two, I would look at this business first. I would look at this business again in more detail. So exit that one. So the third one, let's go back. So this filter I used to highlight Medica this year, and here it is. So we're going to go back to SharePad, and we're going to put a filter, apply. Again, you can install this filter from the SharePad's library, and this was Medica. Okay. So this was looking for growth companies that had grown over the last 5 years, but without acquisition, so organic growth. So turnover up, profit up over the last 5 years. I was looking for companies with a reasonable margin and ROE, so reasonably quality companies, cash on the balance sheet, net cash, and spent nothing on acquisition, so completely organic growth. And I've got 40 different companies here. and some familiar names. There's Medica, and I'm going to look at this one, Sophian. So what does this business do? So let's have a look, and here we go. It's a software business, and its solution supports strategic road mapping, idea development. I don't really know what all that means. Sounds exciting, but I'm not sure exactly what that means. It reports in dollars, so that is something to bear in mind. The directors have been on the board for a long time, 2000. The chairman since 1993, so he's been there a very long time. And it's been listed for 20 years. So let's look at the summary. So the growth numbers here look alarming. So what is going on here? Because these are for the current year, and it looks to be a collapse in profit forecast for this year. So the growth in the last 5 years of profits 500% according to here, that looks like unraveling this year. So what is going on there? Debt's been paid off, cash conversion looks good at 100% plus, so that looks good. It's only paid 2 years of dividends. It's been listed for 20 years and you've only had 2 years of dividends. So the margin is healthy at 19%, and the ROE is good as well. So let's look at the history of this business again. So revenue. So that was the tech boom, and revenue has gradually recovered, so that's rising nicely, so that's okay. So profit. Right, so there's large losses in the tech crash, and it looks to me like this business never really made a profit of any size until the last 3 or 4 years. So the track record may be short. So the margin, there we go. So margin, that 19% margin has only been achieved last 2 years. So the track record is short. This should show similar. Here we go. So the ROE, what was 31% here. Again, so the track record is short. So, and the dividend, there you go, 20 years, and you've only had 2 dividends. So let's look at the cash. What has happened here? So the cash is in green, and the debt on the balance sheet's in red, and the debt's been paid off, and the cash has gone up. So that looks pretty good. We can look at cash conversion as well. We can ignore this because this was all lost. We can just look at the last few years because we know that the track record is short. So last year cash was higher than earnings, which is good. So the red bar higher than the green, but these 2 previous years has been not so good. So we need to look at that. Investigate that. So let's look at financials, cash flow, and we can look at, let's see, so working capital. So working capital, we've got 0.12, which is large compared to profit here, and then reversed 1.5. So working capital looks okay-ish. The trouble is we've got a short track record with this business, so we can't really deduce the trends as much. If you go back here, is it going to, for the next few years, is it going to be like this, cash generating, or like this, where the earnings all been absorbed into cash, into something else other than free cash? Don't know when we've only got 3 or 4 years of profit to go on. So let's go back to cash flow. This deferred tax line here, SharePad includes this. This is distorted some of those ratios on that previous chart. So operationally, it looks okay, but difficult to tell with capex of 3 and depreciation of 2. So not too much difference there. So it looks okay, but because of the short track record, we can't really deduce too much. So let's have a look at the balance sheet. Always worth looking at large liabilities. So here we've got liabilities on the balance sheet. So the big number here is 12 accruals. So we need to discover what exactly accruals are. Always worth double checking what any large liabilities are. So we can go to the news, which is the 21st of March, and the final results. We can scroll down. And we look for the balance sheet. And here we go. So the accruals of 12 is this, deferred revenue. So it's 9 here. SharePad has taken 3 from other payables and lumped them into with this 9 as accruals. But this is an interesting entry. So deferred revenue is upfront customer payments. So as a software business, this is a software business, so maybe the clients pay upfront for an annual license. And in which case deferred revenue is the revenue that's goes beyond this accounting period. So if you pay up front for an annual license, some of it will be recognized in this year, and the other part, which is to be recognized in the following year, is accounted for as deferred revenue here. So they've got $9 million of upfront customer payments, and when you think about the cash here, 17, 9 of that is just customer money effectively. I don't know if they could ask for a refund, maybe, but I wouldn't take that as truly surplus cash for the company. 17 million, I would subtract the 9 from the 17 to get 8 as cash that is truly surplus for the business there. So that's just something to monitor. The real issue here with this company is what is happening, or with these forecasts, what is going on here. So we need to look at the news, and we can look for the 22nd of August, which is the half year results. So what happened? So revenue's down 2 million, and EBITDA is down a little bit. They don't give a profit figure or earnings figure, they just give this EBITDA figure. So we need to scroll down and actually find what has gone on. So we scroll down and we find that $2.8 million last year in the first half, and that's crashed down to 0.8. So profit has collapsed. So sales was down 2 million. This is interesting. If you look at the costs, so the costs have stayed the same. So 4.2, 4.1, 2.4, 2.4, 1.9, 1.9. The costs have stayed the same. So the 2 million of sales has dropped all the way down, and profit has dropped by 2 million as well. So that's the opposite of economies of scale, where had sales risen, profits would have risen even more, soared, but the opposite has happened. Sales down, costs stayed the same, profits have collapsed. So why have profits collapsed? So we need to read what the chairman has to say. And he says, here we go, we closed 18 software transactions in the period, and last year it was 29. So they've just sold less software. And if we look at this next line, they talk about a traditionally perpetual licensing model. So perpetual is interesting. I wonder if these are one-off contracts. So if you buy a perpetual license, you pay, and then that's it. Maybe you pay a bit more later if you want to upgrade, but essentially these could be one-off contracts. I'm not so sure, but I mean 18 seems a small number. So I mean 2 or 3 extra contracts or less contracts each year, perhaps, and then earnings could be well above or well below expectations. So it looks to me like a low number of high value contracts this business is dependent on. So maybe lumpy software here, lumpy revenue, deals. And they talk about visibility as well. I don't know how this figure of 25 million is calculated, but they say visibility is 25, but it was 27 last year, so that's not great. And also they talk about an SaaS model, so software as a service model, which effectively means customers either paying monthly or yearly for their software rather than all in one go up front with the perpetual license model up here. So that's not great, because the business at the moment is the overheads are geared up for this licensing model where the customers pay more initially, and changing to a more predictable, which is great, predictable revenue where the customers pay every month or every year. That's great, but in the meantime revenue is going to be lower as they transition to this model, and I think profits could be very haphazard in the next 2 or 3 years as the new customers come along and pay monthly or yearly rather than all in one go. So that's something to bear in mind. Let's look at the forecasts. There we go, forecasts here. So we can look at the EBIT, and 4.8 profit is what the brokers are expecting, $1 million. So we can go to the income statement and we can look at the half year as well. So that 0.8 million here. So to get 4.8 from 0.8 in the first half, the second half needs to be a 4 million profit, which looks ambitious, because when you work out from the previous year 2018, the second half profit was 3.5. So you need companies, or the brokers are expecting a better second half this year than what happened in the second half of the previous year. The same with sales as well. I think the brokers are looking for 22 million of sales in the second half, but it was just 18 in the second half of the previous year. So I think the brokers are looking for 10 to 15% growth in the second half over and above what was achieved last year, which might be a tall order, I think, because if you click on the news, go to the AGM statement here in June. This was 2 weeks before the end of the half year. So, and management, lots of upbeat stuff here. And in the outlook, they say the board remains confident of achieving our full year expectations. So that's interesting, because 2 weeks to go before the half year, they were pretty confident of how things were going. And if you go back to the headlines, and then in July, here we go, 24th of July. So 3 weeks into the second half, they own up by saying, oh, sales in the first half were down 2 million and EBITDA is going to be 2 million, which they don't say it's below expectations, but judging by the share price on the day, it was below the expectations of many people. So I don't know. The brokers are, and presumably the company is quite bullish on the second half. All I can suggest is that let's hope the management have got a better view of trading in the second half than they did here at the AGM, because I think they're expecting contracts to be signed in the final 2 weeks of the first half. They didn't come through, and they look to be, presumably the management expect those contracts now to be in the second half, but let's hope so, and the board have got a more accurate idea of what's going on than they did at the AGM. So of the 3 companies I've looked at, let's go back to the summary. You can go back to the summary on Sophie, and you're paying a 24 times PE for those earnings, which require a strong second half. So it's not obvious value to me. And given the short track record and the change of revenue model as well, so from the perpetual model to the software as a service model as well, so there's a lot going on here. I'm not too confident. I think of the 3 companies, I would look at Headlam first, and then XP maybe in a year or 2 when the issues are resolved. I'm not entirely convinced about Sophie because of the short track record. Even though the record of the last 5 years is great, it may be starting to unravel, and the change in the revenue model as well. So I'm going to wrap that up. So that is the 45 minutes done. And I'm now going to turn my attention to the Q&A. So what do we have? If there's anybody still listening, so let's have a look. Okay, so I have a question here from Phil Ratcliffe, and he says, could you please go back to your second filter and look at Aviva for me, please? Okay, well, insurers are not my strong point. So the Aviva came up on the second filter. So filter apply, that was Rightmove. I'm not going to add too much insight into this one. It's an insurer. These are very tricky businesses to evaluate, and you could be here all day. My advice with Aviva is, if you're a stock picker, try something a lot simpler, a more simple business. Insurers generally have a poor record. We can look at the financial charts. Let's look at dividend. Dividend's been up and down, so you're not going to get much predictability. Presumably this would be a value share at some point. You would hold it when it looks cheap and sell when it looks fair value. The earnings, look at the earnings up and down. So unpredictability, it's not very predictable. You would look at the yield, and the yield is not shown. So I don't know. Sorry Phil, I wouldn't spend too much time looking at Aviva in any great depth. It's not a business for me, and you could do a lot better, I think, looking at simpler, more understandable businesses than Aviva. So lots of questions about my financial charts. Colin says, can I import Maynard's list of charts? We'll see. We'll see, Colin. I actually know who Colin is. We can sort something out. So if you like the charts, if you like these charts, let's look at headlamp. We can sort something out. So I'll try and make these available through ShareScope. So stand by for that. So Andrew O says, do you prefer ROE to ROCE or ROCE? So return on capital employed. So let's have a look at financials and summary. So I tend to look at cash-rich businesses, so where there's no debt. So the difference between return on equity and capital employed is the debt. So if you've got a company with lots of debt, you essentially ROCE adjusts for that debt. So I tend to look for cash-rich businesses, and in which case it doesn't matter. The figures are generally the same or thereabouts. So if the company had a lot of debt, then I would look at return on capital employed. But the businesses I tend to look at are cash-rich because there's less risk. Companies with debt, lots of debt, always, if something goes wrong operationally, then the debt can magnify the trouble you get as a shareholder. So I tend to look at ROE. So Andrew Latto, he writes, lots of filters. Do you have a favourite to find stocks? So not really. Let me exit this one. On filters generally, you should experiment with filters. I'm always experimenting. All my articles here, they've got different, I sometimes reuse the same filters, but lots of different filters here. If I go to filter and apply, this is my own account, so I've got all these different filters where I'm testing, and the ones I've used for articles, different filters. So there's all sorts there. So I'm always playing about with different filters, tweaking them, just to get an idea. This is just an idea generator, so you get a short list of ideas by applying a filter, and then from there you can just find a short list. Although 51, you can find a short list of companies here to look at. So I don't have a favourite, but I'm always creating new filters and tweaking them to get ideas. So C. Robert asks, do you find SharePad data good enough to make decisions from, or do you spend a lot of time in the annual reports too? So SharePad is an idea generator, so you always should check the annual report, because there's always little notes in the annual report which SharePad or any other system just won't pick up. So you use SharePad for ideas to shortlist. You've got 2,000 shares in the LSE, and I use this filter to shortlist them down, and then from there I can find out where to look. So for cash conversion, so I need to hone in on that first, and then maybe I can find, without reading the whole annual report, just go to the notes in the annual report which concern this. So it's using SharePad is a shortcut to ideas, and also exactly where in the annual report you need to look at. And also, so looking at XP, I've decided, well, I'm not going to look at that right now because there's a lot of issues, so I don't need to look at the annual report. There's enough here to tell me debt's up. I don't need to look at the annual report right now. I'm going to look at maybe a different company. So Graham Sherry writes, do you use SharePad to also track your portfolio? Well, I've got my portfolio here. Oh, let's exit. So I do monitor the ups and downs, and amazingly today some of my shares are actually up here, but I track them up, the ups and downs. The value of them I use something else, so I don't use SharePad in terms of calculating returns, but I monitor my shares, the movements using SharePad. So yes. So Banana Z, do you have preferred market cap size? So I tend to look at smaller companies because they're easier to understand. Generally the accounts are easier to understand. Larger companies, they're harder to understand and more people look at them, so lots of city analysts look at these larger companies. So Unilever, let's say there'll be hundreds of people looking at compiling these forecasts here, whereas for a smaller company, let's go into my portfolio and have a look. Let's say, I don't know, Bioventics, there may be only 2 or 3 brokers looking at the company, so are more likely to get an advantage with a smaller company over the wider market than a larger one. So that comes with risks, of course, because smaller companies tend to be less established, and so they're more likely generally to have trouble sometimes. So you've got to be careful, but I prefer smaller companies just because they're easier to understand. You have got more access to management as well, so it's unlikely I'll be talking to the chief exec of Unilever anytime soon, but I might be able to talk to the chap who runs Bioventics, and I can get a greater insight of that business. So yeah, smaller companies, but nothing, I don't have any definitive limits, so I don't say a cut off of $1 billion or anything like that. It's more to do with the company itself, and if it's a large company that meets a lot of my criteria, then I'd not have a problem. So companies such as Renishaw, which I looked at earlier on this year, that is over $1 billion market cap. That's a good business, so I have no problem looking at that. At the time it had a market cap of $2 billion. So yeah, so any but generally smaller companies, but it depends on the quality of the business. So Phil Ratcliffe again, he's asking about a YouTube session on how to build the financial charts. Okay, we'll bear that in mind. Ian Hargraves says, any chance of a webinar of understanding the financial ratio? So okay, so future webinars, I would drop SharePad a line. If you enjoy this webinar, drop SharePad a line, contact them using the usual way. We can judge support as exactly what webinars people want to see, and then we can take it from there. So if you're interested in another webinar, financial ratios, constructing charts or anything else, contact support here. We can see what we can do. So another question from Andrew Latto. How do you develop filter criteria? Working back from the criteria that have worked, or starting from scratch. So a bit of both. So look for, you can try obvious filters, create a filter, new, low PE, high yield, that sort of thing, and work from there. Also, I try different things such as like sales. I've got a revenue per turnover per employee revenue filter here as well. So trying different things. It's just a matter of experimenting with different filters and getting different names on your shortlist. So looking at yield and forecast PEs and yields, that'll just bring you the same old shares all the time generally. So experimenting with what makes sense, interesting companies. So companies with a high sales per employee, which I found with earlier on this year, Fever Tree and War Paint. This is here. So that's an interesting, you could filter Fever Tree on ROE, but it was here, this turnover of employees, where every employee at Fever Tree effectively generated £3 million each, which is huge. So searching for that is one idea, which is different ratio from other people, the traditional low PE, high yield type of filtering. So it's a bit of both, Andrew. So final question. Ian again says, can you just show how to download your filters into my SharePad? Certainly, Ian. So we're here. So filter, apply filter. So here, this is the library. So you click library and you scroll down to find my filters. So my filters are all here, and you can click on the one you like and then just click install and it's done, and you'll see them. You say installed up here, and mine are all here. That's it. So that is it. I hope you enjoyed this webinar. So should you have any questions about SharePad or the filters and charts I use, then just please contact SharePad support here in the usual way. If you missed anything, don't worry, a recording of this webinar will be published very soon on SharePad's YouTube channel. So until next time, I wish you happy and profitable investing with SharePad. Thank you for watching, and goodbye.